Welcome to the Rose Show podcast. Thank you, everyone, for joining us today. I have the high honor of being here with Michael Guyette, CFA. As you know, I'm Rosanna, your host, and we are excited to begin this very profound discussion with the man behind the Leadlag brand. You are a winner of countless awards, 5 times Dow and Founders Award. You have ETFs. You have a mutual fund which you manage. You're the publisher of the Leadlag Report. You always provide consistent market analysis with proven high yield investment strategies to maximize returns in volatile markets. And now you've become an amazing media personality and influencer with your podcast and your YouTube. Michael, is there anything you don't do?
Sleep, I think, is the proper answer there, and apparently not know where the unmute button is. I appreciate the kind words there. I am a believer in the idea of doing as many things as possible in as efficient a way as possible, with the hope that at some point something is going to favor one of the things that you're doing, which is why I try to do so many different endeavors in my life.
Wonderful. Thank you so much for being here today and your very busy schedule of conquering the world. You are a true serial entrepreneur. And this is a high honor as well, as I've been saying. So I love your mindset. You have an empowered mindset. As you said, you're very efficient. You try to do as much as possible, and we admire that. So, Michael, please tell us how it all began.
So I in terms of the investment industry, kind of grew up in it to an extent. My father had worked with a guy named Bob Farrell, who was a relatively well-known technician in the late 80s at Merrill Lynch. He left to start his own firm, Registered Investment Advisory Firm, in 1991. He wrote 2 books on markets. He was a very ambitious individual, and a lot of that came from his own origin story, in that, he was from Egypt. He was as poor could be. Left Egypt, came to the US because he wanted a better life, had to learn the culture, learn the language. One of those cliche stories where his sister was already here, and he already had owed her $200 and worked at the gas station for a bit of time, but was always very hungry and driven. And I always go back to, like it or not, folks, we get by osmosis personality traits from our own parents because they're around us all the time, right? So I think a lot of his story, obviously, and that energy and that drive kind of transferred to me. In my case, I loved markets. I was never kind of pushed into markets. I heard all the things my father would say, back and forth with my mother about stocks, about the macro economy at a very young age at the dinner table. I was always under the impression that I would take over the family business, the family investment advisory firm. But as is usually the case, as you know, Ro, the life is very funny in that you may have an endpoint, but the path is all that matters. So I thought I would take over the family business. In 2008, not only did you have the great financial crisis, but my father passed away. I got my CFA charter, and my whole world was turned upside down, right? And I think a lot of sort of my own ambition in doing so many different things, going back to the early part of the conversation around hoping something hits in a big way at some point, is because I'm trying my best to not relive a situation where I have a vision for just one thing and that vision doesn't come true, at least in the here and now.
Wow, very deep. Thank you so much. What I picked up on you, and I'm a serial entrepreneur as well, is that everything you do your best. And you must have learned that from your father, because that's a very noble trait. Because there are a lot of people who do a lot of things, but you really do your best. And it comes through in all your work. Your papers are amazing. Your white papers, I love them. And he must have had challenges. And I know you mentioned your path was not what you had planned. And I'm so sorry to hear about your father's untimely passing. But could you tell us about those challenges? And apparently you've overcome many, because where you are today is very impressive.
Well, no, but I'm still challenging. I think that's kind of the sort of environment that last year unfortunately put me in particular. But there's a few things. First of all, in the case of it's not just my father, it's also my mother. They're both kind of, my mother's still alive, very much, I think, perfectionists, right? I think you have to go all in as much as you can in as many different endeavors as possible, which is a strange thing to say, because it's like there's only so many hours in the day to have a concentrated effort on one thing, let alone multiple things. But I'm sure you know that saying, right? If you want something done, give it to a busy person, right? So I think a lot of that also is just part of my own DNA. When my father passed in 2008, I was at a stage in my life, in my career, where I had no idea what the hell I was going to do, right? So you had the great financial crisis. I'm a nobody. Nobody knew my name. I literally just got the CFA charter in 2008. It didn't even matter in my mind, because I thought the entire career was over, right? My entire vision was not going to come to pass in terms of being a person in the industry, running a business, which I always took seriously, right? I was a kid back in middle school, high school, that would read all these books on investing, on technical analysis, on, while everybody else was, outdoors and playing games, I was the nerd, right? Reading books. So I started doing a lot of back tests, right? And back tests on markets was one of TradeStation's clients. And I did that because, as you know, right, finding a job is a full-time job. So I needed to generate income for myself, but I needed to have it automated so that I could be all in on trying to find a job. So I got all in on back testing to try to understand if I could create a system that would allow me to generate profits from the markets while I try to actually reset my career. A lot of my cynicism around market research comes from those days, because I've tested thousands of different types of rules-based approaches and indicators, and 99% of them don't work. It's largely randomness. But a lot of that was from the outgrowth of sort of having to survive, right, after 2008. But I'd seen my father go through drawdowns in life too, obviously, as is always the case. So I didn't let that drawdown necessarily stop me. I ended up working for a small investment advisory firm. The struggle there then was, how do I build a name when back then you had already some very well-known financial influencers, guys like John Molden, Barry Ritholtz, Spark Faber, sort of these guys who have been very successful and that people would gravitate towards. Found a way to put my research in front of all of them, and had each of them publish my research. Then I launched my mutual fund in 2012. I launched a risk-on, risk-off strategy at the exact wrong time, right before QE3. So no real risk-off, and all the wrong risk-on with emerging markets and small caps. 2020 was a really good year. So that mutual fund was up 72%. But then I find myself struggling again, in that here I am 10 years down the line after having reset my career, my life in the industry, building a name, busting my ass every day, traveling and presenting and trying to fight a cycle that didn't favor my approach with the mutual fund. 2020 funds up really strong, and it's like, all right, now I'm about to break through, right? I'm at the escape velocity point in my career. And then as is typically the case, it's never that easy. Then that fund goes round trip. I have to launch 2 other ETFs at the exact wrong time again. For whatever it's worth, by the way, apparently my timing sucks on launching funds in terms of where I launch them in the cycle. But I think this is kind of the thing. It's like, if you believe in what you're doing, you can't let the small sample stop you. You had mentioned this point about effort and work ethic. In some domains, the harder you work, the more likely you are to get a bigger or better outcome. In the domain of investing, there's no clear link between effort and results, because there's a degree of randomness, right, when it comes to investing in markets. And and when you happen to launch a strategy based on the cycle that you're in or going towards. So you can be running really fast, really hard as an entrepreneur in the financial services field. It doesn't necessarily mean that you're moving forward. Whereas I think in other industries, it's a clearer link, which is really interesting, I think, more on a side note, because it makes it hard to be keep your motivation high. Right? It's like if you can't draw a direct link between your effort and the results, then why do you work so hard? You work so hard because you're trying to build the audience for when, you know, the cycle favors whatever you have out there.
Love this. Thank you so much. You're 100% correct. With investment, it's not about your inputs producing a certain amount of outputs. There's that randomness element. There's an opaqueness. We don't see everything that's there. And we have to make decisions based on not having all the information, plus all this other volatility and other issues that happen. But you're certainly doing your best, and I admire it. And, you know, when you talk about all these different things you're doing, I'm curious, what is your true passion? Do you have something that you hope sticks the most? What are you enjoying the most in this process?
Yeah, I do enjoy doing the content. I do enjoy talking to people like you and doing the podcasts. And I enjoy when the, you know, performance of my funds is obviously high because, you know, investors are making money. Obviously, I'm making money in that kind of situation. I think in another life, I probably would have gone full on musician. So, you know, I'm a songwriter.
Wow.
I've got a few songs that I have out there, an album actually. And it's more of a side hobby. To me, it's more just, I think everybody has to have some kind of creative outlet that's productive. I mean, a lot of people have outlets which are destructive. That to me always sounded fun, but the idea of being kind of a starving artist, I think, is not exactly something you want to strive for.
Wow, you're like multi-dimensional. I love this. Well, I have to say, I love the music on your Leadlag podcast. Every time it starts, I'm like, yeah, like I love rock. So is your music rock?
Yeah, no, it's on Spotify. It's under the band name Fortunate Fall, which is a band name I had owned back in like 2001, 2002. I always loved that concept of the Felix Coppola, the Fortunate Fall. All right, it's kind of the idea that you go through a drawdown in life and it ends up being in some ways the best thing for you.
Absolutely.
I think there's a lot of power to that as a mindset, right? That you shouldn't view every setback as a negative, but you know, maybe as a chance to kind of get back higher, right? So yeah, it's all rock music. It's music I've written some, you know, I essentially coordinated with a producer, worked with a bunch of other session musicians. I did a couple of instruments, and you know, it's been well received for something that I'm not really taking overly seriously.
I love it. Well, maybe you will take it more seriously. I'm definitely checking it out. I'm going to listen to it. You're very talented, so I'm sure your music is fantastic. You know, you brought up a great point about the drawdowns, and we all go through many. And I am older than you, and I've lived life longer than you. And I got to tell you, you know, through my experiences, it's through the challenges that we find the opportunities. And it's those times that are most difficult that we grow the most, and it builds character. So, and everything happens for a reason. That's how I live my life. And I believe that everything has to have some meaning for us, and we have to search for it and learn from it. And we emerge stronger and better. Apparently you have, and I know there are always lifelong challenges. Every day is a challenge. So we're always combating those bombardments of challenges, information, and everything that we have. I want to go back to your father and his book. I just ordered it from Amazon today. I love, has a sweet spot in the middle, how he combines all the economic, the fundamentals, and the technicals, like a Venn diagram with a little sweet spot in the middle. And I love that. I love that multidisciplinary approach. My field of focus actually was decision information sciences, which is behavioral economics, which is a multidisciplinary approach. So I admire that. And that's how I do my investment. I'm also an investment advisor. I just passed my Series 65, by the way. But anyways, thanks. So I am excited to read his book. Do you base your philosophy, your investment style on that similar approach?
I think it's a mindset. So different from the way my father would approach things, I prefer to be more rules-based in how do I approach creating a strategy for market. So my father was much more discretionary, meaning it was based on his view of the markets, based on all these different multidisciplinary approaches. And a lot of the research I put out there obviously kind of factors in all this. But I tend to prefer a rules-based back-tested approach because I'm actually not of the belief that I can necessarily beat a rules-based approach, whereas other people think they can based on gut feeling or based on other analysis that they're looking at, making their trades more dynamic. It's not a criticism on discretionary trading or discretionary asset allocation. It's just sort of my own kind of personal focus. So I believe it was page 312 where there's a section my father wrote, and the heading is utilities lead the market. And it's, just 4 paragraphs. But that always kind of struck out to me. Utilities lead the market. So I actually started to backtest that idea. And that was the genesis of not just one of the indicators that I use in the mutual fund, but also is exactly what the 2014 Dow Award paper is focused on, the predictive power of the utility sector. It was literally because of that one page, right, that got me to kind of go down the rabbit hole out of whatever the 400 some odd pages I think the book is, or 450. It's on the book itself. To me, it's always kind of a crazy thing to look back on. So in 2011, I was ready for Seeking Alpha, right? And in early June of 2011, I said the summer crash of 2011 or the great readjustment. So I had put a thesis out that we were going to see a summer crash in stocks. And then since then, up until August, when the crash actually did happen, I think I wrote like 20 articles, 17 of which I said summer crash in the title, right? So I was very aggressive in making the argument. Markets went down heavy. You had the debt downgrade by S&P, and Treasuries ran and equities fell. So I started getting the media, and then I just happened to randomly go on Amazon one weekend, and I saw, I looked up used copies of my father's book, and I was just curious because it was out of print from 1990 to 2011. And the book, which before was maybe selling for a penny because nobody wanted it, suddenly was selling for like hundreds of dollars because people thought it was me as opposed to my father's book. So I said to myself, all right, I got to do something with this. So somehow my mother kept the original publishing contract from 1989 into 1990. She had that contract. I then basically went and tried to figure out who the publisher was because there was so much consolidation over the last decades. Got the rights to the book back for $1. Now I have this physical copy of Intermarket Analysis Investing, no digital copy. I went to a company to literally scan every single page from the book into a PDF format. Then I converted the PDF into Word, and then I literally started editing every single page. So I probably have read that book, 30 different times, from an editing perspective to make sure that I translated it correctly. It's pretty much untouched. The only thing I added was a forward at the start of the book, but it's just funny to me how a book that he put a lot of effort in that was never pushed or was never a bestseller. I'm proud of the fact that people are paying attention to it now through, kind of the visibility that I have. It's become more than just sort of a way of completing my story, but it's a way of honoring him.
Absolutely. I think you make him very proud, Michael, and quite a legacy that you have now. Michael Gayed, he was ES and you are A. Is that correct?
Yes, his first name was Ehab because he was from Egypt.
Very nice. Well, as I said before, everything happens for a reason. And it seems that actually was another one of those reasons. Page 312, we'll definitely check out that page. And timing is everything, as you said. Agree again. Now, few understand. Please tell me and our viewers, what is the meaning behind that and how did it originate?
Well, apparently few understand what few understand this actually is supposed to be about. So I am wildly cynical of narratives. Again, it goes back to my days backtesting, right? And seeing people talk about things with so much overconfidence when I know for a fact whatever they say is either lagging or randomness. It's not leading or coincident in terms of the present day. So the whole few understand this is actually a meme from the Bitcoin Maxi community from like 2017. It's not something I came up with. What happened was in early 2020, right, as Bitcoin is starting to run post-COVID, I was curious about Bitcoin and it's running, and there was almost this vitriolic response to me questioning things, right? Just not to challenge an investment thesis, but to challenge what people were saying about the investment thesis, the narratives around it. And there was a weekend in particular where I said something that had related to the idea of liquidity and divisibility with sats, that I got like the Bitcoin mob just went after me. Oh, you're a CFA charter holder. You know what you're talking about. These are like, you're so stupid, like all this kind of nonsense stuff. So then I basically went nuclear. I kind of flipped. And then I started using Few Understand This to make fun of everything that people thought that I didn't understand, which I knew I understood, obviously, right? So it became sort of a satire, comedic response to everything that I started tweeting out. Then I started mixing in exquisite, atrocious, almost creating a persona. I then put lumber and gold eyes on my Twitter profile to make fun of the laser eyes, right? When back then, towards the Bitcoin top, every single person, including actors, were putting laser eyes to show their support for Bitcoin staying and keeping their eye on the prize. So it became sort of a satirical, comedic type of dynamic. The funny thing to me is like people think it's actually me being arrogant. It's like they're not getting the joke. The whole point of the Few Understand This is exactly that. Actually, a lot of people do get stuff, right? That nobody has special knowledge, right? That we should all be humble because nobody knows what tomorrow brings. But it's kind of like that joke, right? It's like if you don't get the joke, you are the joke, right? Which it's just kind of just amazing to me how that works. So it's a persona for Twitter. I think it's hilarious. A lot of people seemingly don't. A lot of people do, but I always make it a point to say it's not being serious about things. Sarcasm, unfortunately, is lost in copy.
I find it hilarious myself. I think it's cute. I love the picture of the lumber and the gold in the eye. I think that's so cute. And you've created quite a brand. And, we have this discussion every once in a while through Twitter about men in the arena and how, there are a lot of haters and trolls, and most of them are because they aren't in the arena. So, I love your attitude. Just keep going with it. To me, you're doing amazing and I admire you. The brand Leadlag, what is the meaning of the word? How did you come up with that word? Is it leading, lagging indicators? Like, how did you come up with Leadlag?
Yeah, and by the way, on that point, it's like, I'm sure you've seen this yourself. I've used the line before, those who contribute the least criticize the most.
Yes, absolutely.
It's really bizarre. And by the way, it's not a new dynamic. I used to be one of MarketWatch.com's top writers, and I would always use the comment section of a MarketWatch writing to be a sentiment tell. And most of the time, it's like that line I keep saying that you're right when the counter argument is an insult. I've said that for years, way before Twitter, way before I started really kind of focusing the content side and attention there. So if you're not leading, you're lagging, right? So this is kind of the point from an indicator perspective. One, I like the alliteration of lead lag, okay, which I have lead lag live too. But it's more sort of a for me, it goes back to this obsession that I have that most things are not predictive, right? So I put out these 5 different research papers. They're all basically documenting the same dynamic, which is that they're leading indicators to volatility and that you can tell where volatility is likely to change based on changes in the demand for money. So it's ultimately all about interest rates. A lot of people will refer to things that I know for a fact are lagging, right? So that was sort of the genesis of that idea. Of course, if I just said the Michael Gaya report, it's not going to get as much attention, right? So I think the Leadlag report is hopefully an interesting enough name for people. And listen, I'm very fortunate. I mean, I have a lot of advisors that are subscribed to it. I don't make any money on the research. I mean, I basically reinvest everything back into my own name, brand building, because for me, the real way I grow in the industry is not necessarily from a paid research service, which is the front-facing side of me. It's from the funds, which I created, which are outgrowths of that research.
Wow. Well, you're leading me right to the next part that I wanted to ask you about are your ETFs and mutual funds. So thank you for all that. Let's go right into your ATAC funds. They're designed to generate absolute returns across multiple market cycles. I find them very fascinating, and they relate to your scholarly, your white papers as well. So your papers actually reference the whole lumber, gold, and in volatility. Love it. So let's start with, you mentioned let's see, let me go with RORO. We'll go with that one, okay? Risk on, small caps, and growth. Risk off, treasuries, and it's based on gold versus lumber. Love to know your thinking, how you found out this whole lumber and gold phenomenon as well. Please tell us about it.
By the way, that term absolute return is really, it's one that people have to be careful with. I mean, it's used in the marketing collateral, but the key part of that is over multiple cycles, right?
Mm-hmm.
Cycles which can take time. Absolute return does not by any means imply you're guaranteed to make money.
Absolutely not.
A month,
yes.
in a quarter, in a year, even over multiple years, if the cycle you're in doesn't favor the approach. You're just trying to create a different type of return stream than beta to a large extent. So absolute alternative, I would argue, are kind of interchangeable. Okay, so first of all, the whole lumber and gold thing, okay, it's always funny to me. I keep making that joke. People tweet at me saying, it's so weird that you talk about lumber, meanwhile they're tweeting from their house. And so it's not my opinion, this is back tested, not just from my work, but others as well. Lumber is a leading indicator of housing, okay, because of framing. So to the extent that lumber is doing well because of the long lag of construction, going back to Leadlag, that as lumber performs, that suggests housing's about to pick up. Well, housing is 18-20% of GDP. It's a big driver of economic activity. It's a big driver of credit creation. So if lumber tells you about housing, it stands to reason it tells you about risk on, right? Just a better environment for growth. Gold is more of a risk off safe haven commodity, meaning it tends to benefit from high volatility on average in stocks. Money flees to that when there is increased risk, at least for a moment in time. So you compare lumber against gold, basically tells you about conditions favoring risky or less risky type of environments for equities. Okay, so I launched RORO November 2020. Okay, it's the ATAC US rotation ETF. RORO is just a way of saying risk on, risk off, but the name of it's ATAC US rotation. ATAC is a tactical, just a play on that idea. So when you have a risk on, risk off approach, you have to first define what risk on and risk off means. So this has been sort of challenge number one, which I keep trying to stress. Risk off doesn't mean no risk, okay, which sounds like really weird. Well, because there's multiple kinds of risks, right? Risk off is ultimately about default risk. Default risk meaning when you're in a recession, for example, companies that are very levered are at risk of going default, of no longer existing, of bankruptcy. When you have high volatility, typically credit spreads widen, investors demand more premium from highly levered players, default premiums increase, and money for a moment in time during that high volatility in stocks goes into treasuries. Why? Because the US government can't go default, right? They own our shit through taxation. So from that perspective, risk off is treasuries. It doesn't mean no risk, it's default risk off, credit risk off. The risk on side is equities, right? And the idea there is that if risk on is about volatility lowering, well, then you might as well go into equities with a little bit of leverage, small caps, large growth. Gold is outperforming lumber, goes all in treasuries. This is based on an index, which is entirely rules-based. So people see my funds, they think it's me doing discretionary trading. It's not. I could die tomorrow, the funds would still run the exact same way with the exact same 1,000+% turnover because it's rules-based. Right? It's yes, it's my intellectual capital, but it's just following signals. So I launched November 2020. Here comes 2021. As you will recall, small caps went nowhere. Large caps kept on pushing higher. Here comes 2022, and you have a very anomalous type of interaction in equities and treasuries, where for the first time in history, treasuries lost more money than equities in a major drawdown for equities. And I've shown those stats, ad nauseum on Twitter. Remember what I said about launching funds at the exact wrong time. I launched a mutual fund, risk on, risk off, right before QE3, very risk on in cycle. I launched RORO just before something that's never happened before in history in the bond market takes place, and in particular in the failure of the flight to safety trade. So the fund goes through a nasty drawdown. Now people see that fund and they say, well, why should anybody listen to you? Right? You had such terrible performance last year. There's an index that RORO is designed to try to track. It's publicly available. You go to marketvector.com. If you look at the index since inception in 2002, using this rules-based lumber to gold approach, you'll know exactly why I launched the fund, right? Why I launched this approach, why I believe in it. My point is that, and I'm sure you see this too, the real challenge when you're an entrepreneur in a domain like this one where you can't control the outcome is that people judge you based on the small sample, which may be unequivocally an anomaly, and then say, you know what, you don't know what you're talking about because you didn't perform in this or that particular year. But I don't control the outcome. And had I known that Treasuries would have failed last year the way they did, I wouldn't have launched the fund, obviously. I'd launch it now, because now there's room to make money and risk off. But I think the lesson there goes back to the struggles point that you mentioned earlier. You don't know what kind of environment you're operating in as an entrepreneur. How many entrepreneurs start a business and it's just at the start of a recession? And they spend, I remember a guy who I used to talk to quite a bit, who's not too far away from me. The guy literally started a restaurant. 9 months in, he finally launches the restaurant, and suddenly the lockdowns happen. And I remember seeing the tears on his face. The guy busted his ass to bring this restaurant to life. 9 to 10 months later, and it so happens here comes COVID. And I give him all the credit now in the world. He survived it, got through it, very successful business now. But it's like, you can't control that. You don't know when that's going to hit. You don't know when a macro environment just destroys all your micro effort. Same thing here, right? I think part of, as you know, right, being an entrepreneur is being really stubborn to not let the macro environment wipe you out, to stay in the game long enough for the cycle, again, to favor you. I always go back to that point. Macro helps you thrive. Micro helps you to survive.
I love it. Absolutely correct. Most entrepreneurs fail. Most businesses, I think, fail within the first few years. There's like a statistics out there that says that, it's about never giving up. And you said the word stubborn. Absolutely. I think I'm probably the most stubborn person. I've been an entrepreneur for 25 years now, and I've been through 2008, was there 2000. I actually started investing right before 2000. Lovely me, right? You could tell we picked ourselves up after that one, but that dot bomb was pretty tough period. It's about never giving up and, learning from the mistakes, and it's about the mindset. And I admire your empowered mindset. And you know what? It's not about the results. It's about the process and the staying power, and to stay through these economic cycles. There are always ups and downs. Okay. And the past does not predict the future. In my opinion, and this is just my hunch, I think your future is going to be very bright. And I think these ETFs are going to outshine. And that's my opinion. I love the thinking and the strategy behind them. I think it's brilliant. And I think you're brilliant. So Michael, I give you credit for everything, and ignore the naysayers and haters. You know what? They're confirmation that you're doing great, because this is some really great stuff. Let's go into JoJo, JoJo. And that has to do with the high yield debt being the risk on. Could you tell us about that? And it's based on utilities. Love that.
So same kind of concept. So it's a bond strategy, also an index, the ATAC junk on, junk off index, also on marketvector.com. So remember what I said, like these indicators, they tend to tell you about interest rates, demand for money. So lumber to gold tells you about housing, which is about mortgage rates. Utilities similarly tell you about interest rates, because utilities as a sector of the stock market, they're very levered, and they can't raise prices that easily. So much of their earnings variability is based on the cost of capital changing, right? So higher rates tend to be bad for utilities because they got to roll over their debt on higher rates. If rates are falling, that tends to be good for utilities. They're high dividend. They are the most bond-like sector of the stock market. Typically, when you're in a risk-off, high volatility period, utilities would outperform equities in advance, leading aspect, just like lumber to gold would also at the same time be weak in advance, right? So in the extremes, they will tend to line up as indicators, but they're different indicators in the rotations because they will have different false signals, meaning whenever you have a tactical approach, you have to consider not just the times you're right, but what happens when you're wrong. So ideally, you want to diversify your false signals with multiple signals, right? So in the case of JoJo, it's using utilities. Utilities outperform the market, treasuries underperform the market, junk debt. This goes back to the point that volatility is tied to credit spreads. Because really what I'm did with that fund is try to create a strategy that would avoid those junk debt blowouts, right? Those spread widening events, hiding out in treasuries during those periods, and then hopefully getting back into junk debt at much higher yields. Again, I launched that July 2021, right? Months of putting the whole thing together with my team. And then last year, as you know, right, last year was a year not for credit spreads widening, it was a year for duration selling off. So you had this wholesale bond market sell off in 2022, but you didn't have credit spreads widen, right? You didn't have default risk increasing. So the bulk of the year, that fund is in treasuries in quote unquote risk off, defense, junk off mode. Turned out the treasuries, right, were the kind of junk last year, given the way it behaved. That really needs an environment where there's some credit events, right? This is also an important point. When you create vehicles, you need particular conditions for the vehicles to really work in, right? So you have a risk on, risk off tactical approach. You're playing offense, defense. You need to have reasons for defense to work. You need to have some declines in markets. You need to have some volatility spikes. You need to have some of these risk off periods, because what happens is, think about it like this. Every time you drive and it's raining outside, you slow down, right? Most people would probably be fine not slowing down, meaning they're not going to get into an accident. So they actually hurt themselves by making their ETA longer because they're playing defense in the event, in the rain, as they're driving, that they might have an accident. But most of the time, you're fine. It's the one time where it becomes very clear all the other times you were right to actually do that, right? Because you don't know when that one time is where the crash happens. So, but you need to have that kind of scenario to see the power of slowing down, right? Otherwise, it just seems like you're always going to be delayed and lagged in your arrival time. So when you have a risk on, risk off approach, you need cycles where there's risk off. When you have a risk on, risk off approach, you need cycles where it's not just dominated by large caps. You need to have a sequence, a path, right, that allows you to kind of get these kind of rotations right whenever they appear. We have yet to have that. It's my belief that that's coming. Partially, that's me talking about my own book. But I think intellectually, it makes sense to argue that we're in an age of more and more turbulence, more and more potential risk off, more and more risk, and an age where the days of passive buy and hold are not going to be as taken for granted for as what we had the last decade.
I agree with you on that. I can't wait to get your thoughts about our current situation. But before we get to that, I want to finish up this portfolio manager discussion with your ATACX mutual fund. Please tell us about that one.
So it's and that's kind of the first iteration of the idea. It's more complex than Roro and Jojo, but probably more similar to Roro, but it has its own dynamics, different signals, still risk on, risk off equities, treasuries. That one can be short duration treasuries. That's why I did comparatively better last year. So with that one, I always go back to, it's more than just signal, it's about opportunity set. So I keep going back to, I launched the mutual fund ATAX in September of 2012, the day before QE3 began, quantitative easing 3 by the Federal Reserve. So all my backtesting was on pre-QE3, pre-zero interest rate policy. Again, I go back to, if you're going to be risk off, you need some risk off. So I launched 2012, with the exception of the end of 2018 and then 2020, you really never had any real risk off. You never had any junctures where volatility spiked in a meaningful way. You had downside risk in equities for that strategy to really stand out. So I keep getting whipsawed playing defense. I keep slowing down entering the storm, never having the accident. So only really 2 very good years for that fund. But the other thing is, on the risk on side, that mutual fund, unlike my ETFs, rotates into emerging markets or small caps. Well, if anybody hasn't noticed, for the last decade, emerging markets have gone nowhere. So I keep going back to this point. If you followed a momentum signal on the S&P 500, God bless, you did great the last decade. You take the exact same momentum signal and use that on emerging markets, it's like death by 1,000 cuts, because there's no persistence in the momentum. The opportunity set is not there. The cycle is not there for the secular move. And again, I happened to launch just as QE3 came and destroyed, I'd argue, emerging market momentum. So to your point earlier about you're optimistic about my future, I'm optimistic. I'm very, very optimistic, because I do believe that higher interest rates, the environment that we're in now, probably resets market relationships to the way it was before 2013, before zero interest rate policy, before this squashing of volatility, before S&P 500 only dominance. And if I'm right in that cycle idea, all that means is that I'm going to get whipsawed less. right? From a trading perspective with these funds, from a rules-based perspective, that I have a cycle that favors the likelihood that a trade works in emerging markets, a trade works in treasuries. That's why I always go back to it. It's like, even go back to the few understand this, when I say there are no gurus, only cycles. It's because I lived it, right? It's the cycles around the opportunity set. And yet people think that if you understand this as me being egotistical. No, when I say there's no gurus, only cycles, that's me being as humble as it gets, because I don't know the future, neither does anybody else. But I do know that if I happen to be in a present where the cycle favors an approach, that's a higher likelihood of success than in a prior cycle that doesn't favor the approach.
Absolutely. I think you're very humble. You actually took the words from me. I was going to just say that. I think what you've done is you positioned yourself ready for when that economic cycle goes to the next phase. And my opinion is that emerging markets should be, I'm bullish on them. You could say that. I think we're going to be in a higher rate environment for some time. I think we're going to have a reset. I think it's going to be a different world. We're in quantitative tightening. There's a lot of moving parts. And I think this past 10 years or so is not coming back anytime soon. I think we're going to be in this phase for a while. And I love your positioning. I think timing's everything. Maybe you were a little early, but I think that this cycle is going to come, and it's gonna be right here with all of these that you have set up. And I'm very excited about all of that. Before we go into the macro, I do want to touch upon some other creation of yours, this new food app that you have, How You Dish. Could you tell us about that, how you came up with that, and if it's available everywhere?
Yeah, it's on iPhone. It's like a 5-year project. I've gone through all kinds of iterations on that with even different development teams. I mean, basically the idea is, because I was traveling so much presenting at CFA chapters, the initial idea was, when you travel, the stat is you tend to gain a pound and a half every week. You're not eating at home, you're eating at restaurants. So I was finding myself gaining weight while traveling, right? Because I was traveling, presenting, trying to fight for the mutual fund and try to build my name. So I said, all right, let me come up with an approach that's meant to be a nutritional way of finding nutritionally healthy dishes, no matter where I am in the country. Didn't really take off on that iteration. Then it dawned on me that really people want to connect with people, so make it about foodies connecting to each other. So it's not something I'm heavily focused on. I've got several thousand users on it, but it's basically designed to be kind of a fun way for people to connect to nearby foodies. I keep debating as to whether or not to change the name How You Dish. To me, it's kind of funny because to dish is to talk, and obviously it's about how you eat, right? And most people connect through food. I am of the mindset that you want to, going back to I think the very start of the conversation, you want to have as many lottery tickets as possible. The app development world is brutal. 95% of most people's times are spent on just 5 apps, right? It's like Instagram, Tinder, Snapchat, and then there's like 2 others. I forget the exact ones.
How about Twitter?
Yeah, I don't recall Twitter was among that, but I think so in other words, with all these hundreds of thousands of apps, they're competing for 5% of one's time compared to all the other mega ones, right? So it's very winner take all, and a very challenging endeavor. For me, it's fun. If it ever takes off, great. If it doesn't, it's there. It doesn't cost me very much. I already put the time and capital into launching it. But if anybody is curious, it is on the iPhone.
Awesome. How You Dish. I love it. It's very creative. And I think that's so cool. I just, if I could offer any inspiration at all to you, is that I've launched at least 5, 6 businesses, probably more at this point. I just simultaneously launched 3 right now. And I'm just always creating, because I just love creating and just turning ideas into successful businesses. And not all of them work out, you learn along the way. But what I've learned is patience. And it's like, I work so hard, okay? And I just feel like, I tell my husband, I'm like, why isn't this working out? He's just like, it takes time. Just have patience. And sometimes what we need to learn in the process is patience. And it's like we're being tested to just not give up and just to have that patience. And I think it's the hardest thing. They say waiting is the hardest thing. I think Tom Petty said that. And so I think your ideas are brilliant, and it comes from my heart. And that's how I am, very passionate person. And I love what you do. And I saw everyone check out Leadlag. and how you dish. It's so cool. So I think we can go into the macro part. The US and Europe are in stagnation. I'm into economics as well. I love reading. I find it fascinating. And this leads to the emerging markets. And I think we need to look globally, diversification across asset classes as well as countries. There's so much change going on. It's exciting. And you always talk about, I love all the things I read from you. It's a lot of thinking behind what you say. And you say, people always look to the right side of the equation when you should actually be looking at the left side. And that's so true. It's about the inputs. You don't just look at the outputs. And could you tell us, what is your left side?
Well, so in particular, when it comes to investing, there's always a degree of error. So the whole reason for the left side of the equation is just mathematically, it's true. Every variable has an error attached to it. So you don't know if the conclusion, the right side of the equal sign, is based on the variable or based on the error, right? This is the thing, based on luck, right? So the only way you can really identify that, again, is to your point, look at the inputs. So for me, the left side of the equation here, it's very, very simple. You had the 7th worst year for the S&P 500 in real return in history. So it was already a very nasty year in 2022. You had the biggest bond market sell-off in history, right? And complete abject failure of Treasuries. You're in what I've called a melt-up condition, to start the year. And you've got a lot of people that are very short-term that are being fooled by the error in terms of market movements and the way they approach day trading, zero DTE options, all this stuff. The left side of the equation is very simple. A lot of loans got taken out at very low rates post-COVID. A lot of them mature in 3-4 years. So a lot of loans are going to start maturing in 2024. There's this great saying, the stock market, nothing matters until it matters, and when it matters, it's the only thing that matters. Right? Nothing matters until it matters, and then when it matters, it's the only thing that matters. Nobody seems to be caring, and the bond market, because default risk is so low, credit spreads are so tight, nobody seems to be caring too much that you have potentially a debt refinancing tsunami coming next year into higher rates. Now, most crises are refinancing crises. This is just fact. If, with all these zombie companies that got, had the luck of having zero trade policy for so long, if a lot of these companies start rolling over to higher debt, suddenly default risk increases. You could have, bankruptcies across the board, which would be risk off because money would then go back in the flight to safety of treasuries. But if it's all going to happen in 2024, the stock market and the bond market would not react off of it in 2024. They'd react off of it in 2023 because markets lead, right? So this is why I keep going back to, I do believe there is a risk, a very real risk of a credit event where suddenly the stock market, the bond market says, we got to be really careful about being overly optimistic because all these loans are going to be rolled over and the Fed keeps saying higher for longer. Well, if the Fed keeps it higher for longer, you're going to have default risk being higher for longer. And that could be where it becomes a problem for a very leveraged society. The path is what matters here. So I don't think it's something that happens tomorrow. As much as I think we might be entering a risk-off period in March, I don't think it's something that happens in March. But you can't necessarily just look to the right of the equal sign, which is the way markets are behaving right now, and extrapolate the most recent past without looking into the lagged effect to the left of the equal sign, which is what happens when all these loans have to refinance.
Excellent points. I love how you think. You think not only forward thinking, but you think very deeply. And, I agree with you completely. I'm very concerned about, we had free money back in 2020, and a lot of money went towards riskier assets that now are needing that constant refinancing for getting capital. And now they're going to be refining at much higher rates. And then the ones, like you said, they're going to come due. Everything is, people are maybe just short-sighted right now and not seeing the forest through the trees, I guess, as they say. There's a lot of events upcoming And the higher cost of debt and capital is very concerning, and it is higher for longer, in my opinion. And longer is the key word. We have persistently elevated inflation, as we just saw the other day, rising core month over month, very sticky. We still have a very tight labor market. There's a lot of, I think this will take a long time, in my opinion. We look at GDP as well. We see mass government spending, inventories are rising. These are all very, classic, precursors to a recession or, stagflation. What are your thoughts about stagflation upcoming at some point in the future?
So it's always a maybe. And I'd say that because, first of all, I agree largely with the stagflation argument. You can't really resolve stagflation unless you have competition, right? To bring down pricing. And the problem with higher rates is that you ultimately actually end up countering the competition, right? Because it becomes harder for new entrants to come in. That's kind of the strange dynamic of higher rates. You can argue it's actually giving pricing power, which makes it even more sticky, right? To just a few companies, because there's not as many entrants, because it's harder to achieve, get capital to begin with. I'll tell you though, I tend to be much more mindset wise I've always been more of a deflationist. I do believe that debt is inherently disinflationary, ultimately deflationary. That doesn't necessarily mean we have to go the way of Japan, but it does suggest that there's going to be more volatility, because every single round of deflation means that there's an illiquidity pulse that's happening in markets. On the higher for longer, it's tricky, right? Because if you have a credit event, that's going to break inflation pretty heavy. I mean, most credit events, most default is because of disinflation or a deflation shock, right? So one way to crash inflation is to crash everything, right? Which would be a credit event, right? So, but we'll see. I'm of the mindset we're probably in the last decade. I'm in the mindset that we are probably at the point of no return on debt, but I'm also of the mindset that I don't know what tomorrow brings, just like everybody else. So I could be totally, totally wrong on that, which is why I prefer rules-based approaches rather than sort of a thesis, which is very hard to know if it's going to be right, except with very long hindsight, in which case it's too late to do anything about it.
Absolutely. Well, rules-based is a very disciplined approach, so I admire that. Thank you so much for that. Now, earnings recession. What are your thoughts on that? A lot of talk about, they say for quarter four, a blended earnings decline. They're expecting about 4.9%. And then the following, they're thinking we might be down 12% this year for earnings. There are a lot of projections out there. Margins are severely compressed. And with this higher cost of debt and capital and production and productivity's down and so forth, what are your thoughts about that occurring this year?
Yeah, I mean, it could be. I think the earnings side has been talked about for a long time, as you know, right? As far as this earnings recession idea. It's always a question of, from an investing perspective, it has current price overreacted or underreacted to that? Because everybody knows it. So it's ultimately a question of, it's an overreaction from a valuation perspective or not. If you have a credit event, that's going to be a massive hit to earnings. And again, the rolling over of loans at the higher rates with lower earnings also. But I'm always hesitant on projections. It's like, keep in mind, any earnings projections are based on models, which is based on history. We never had a period like this before in history. So it's hard to really know if any of those estimates really are based on something that you can rely on, broadly speaking. But yeah, this is what happens when you're in an environment where nobody knows what's going to happen next. There's a lot of uncertainty, a lot of variability around earnings. But earnings don't matter if everyone's bullish. I mean, that's just the reality, right? They'll use the excuse that as markets are going up, that we're back in a period of PE expansion, which basically means earnings don't matter, right? Because it's all about momentum. It's just code for FOMO. I don't know if you can necessarily invest on it. I guess that's kind of my point.
Yes, exactly right. And that leads us to where we're at right now with the market. It seems to be risk on. It feels like we're back in QE with a lot of risky assets running. And the market has just been so bullish, and it seems like there's a lot of FOMO going on right now. What are your thoughts? Are you bullish right now? Is it a temporary transitory phase? Do you think this is another bear market rally, or some people say a temporary bull market? What are your thoughts on what's going on?
Well, so keep in mind, we're in the third year of the presidential cycle, which tends to be a pretty strong one for equities. Just a backdrop. And after the first week of January, I went back to conditions favor a melt up, and that's because lumber was strengthening, utilities were weakening. I think that I don't know how much longer this lasts. People keep in mind, bullishness can last for a while. Like overbought stays overbought, right? It's just because something's overbought doesn't mean you sell it tomorrow. I mean, there's much more predictive power on the oversold than the overbought. I just think when you actually backtest it. So I think we're in general, a better environment for risk on assets. I think a lot of people are still fighting the last war, meaning they're still very bearish and trying to short things. I don't necessarily believe the bear market is over, right? Because I think it will ultimately end with a credit event as sort of the capitulatory moment. But it's very tricky, right? Because, again, you had the 7th worst real return year in history last year. People are expecting a repeat. I'm not to say it can't happen, but do you really want to bet that you're going to have a repeat of last year, which was already pretty extreme in the context of everybody being talking about recession? It's at some point contrarianism pays off, not because it's about being right. It's about because the payoff for betting on the contrarian pot is a lot larger because fewer other people are actually betting on it.
Seems the only certainty is uncertainty at this point. We're in uncharted territory. Makes for exciting times. I'm sure there'll be plenty of opportunities upcoming. You said something, I love, as I said before, I love the things you say, very interesting, well thought out. The Fed doesn't own the bond market. The bond market owns the Fed. Could you tell us what the meaning behind that, please?
Yeah, so it's a mistaken notion, this idea that the Fed controls the bond market. It's just not true. Long duration yields started rising really late July, August 2020, long before the Fed started hiking rates. They don't control the short end. When the bond market sells off in terms of credit spreads widening and in terms of default risk premiums, that's when the Fed responds. The Fed is reactionary. They're not anticipatory, right? So the bond market will see it first and then basically send a message to the Fed, you better start acting before this illiquidity or liquidity gets to be too extreme, right? So it's a mistaken notion to think that it's don't fight the Fed, it's don't fight the bond market, I think is sort of the real point. And one certainty, unfortunately, is that while the bond market owns the Fed, my calendar owns me. So unfortunately, I have to start to, I've got a call coming up here. But I think the key thing, again, for everybody that's listening to this is, first of all, show support to the roadshow here. But I always go back to question narratives. There's a lot of stuff that people say that has no predictive power, that doesn't make sense if you just do the Socratic method, peeling back the onion and asking further questions down the line. And hopefully this conversation has added some value to the listeners.
Absolutely. Thank you so much. I know we're running out of time here. I have so many more questions for you because you're such an interesting person and so brilliant. I guess we'll end on this. What I'd like to know from you is, what are your business plans for the future going into this year and next? More ETFs, more apps? What do you have planned?
Yeah, I think more. I have another fund that's in the queue, right? That's an equity only fund. So not risk off treasuries. It's a way of playing leverage for the long run in equities. I'm waiting to launch that until hopefully equities do go down so I can time the cycle better than my prior funds. But yeah, that's sort of the thing. And then, listen, when you're an entrepreneur, new ideas always come to you, right?
Absolutely.
So you know it yourself.
Yes, and I can't wait to hear some new music from you as well. I expect to hear more. Thank you so much. A profound renaissance man behind the Leadlag brand, Michael Gayed. Thank you so much for being here today.
Yeah, no, I appreciate you. Very good. Thank you.
Thank you.